you're not gonna get a loan, a long-term loan on a short-term flip. So what is the goal for the property? And then does the loan positively affect that goal? You have to double check the loan to make sure that it fits your criteria. I'll give you an example. I have a property that I business partnered with my mom, that cash flow is about $1,900 a month. The loan we got was 5.5 with 5-year balloon. Just astronomical rates. The balloon was like, it was a very dumb loan. But why did I do it? So I did it because it quickly got me into a deal that I was going to lose. I got the deal I got it at least for 5 years, and it was going to cash flow $1,900 the day I bought it. So what I did was I got the loan, and 3 years later, I refinanced it into a regular 30-year mortgage with another bank at better rates. So not always is the worst loan or the worst rates loan the worst loan to get. So you have to figure out why you're getting the loan to help you with your deal. If you're like, oh, this is going to give me a loan. Like she was like, yeah, we can close in 30 days. No problem. You're going to pay a bunch of really high fees, but at the end of the day, we'll get you the loan guaranteed. And we're going to keep it in-house. I was like, great, give me that loan. I'll figure it out later. Would I have done that if I had time for the deal and I would have done everything else? Probably not. But at that point, I didn't know what I know now. I just needed a loan in the next like 5 days. Okay. So this is important because this means that you're going to pick the right loan for the right deal. If this conversation's a little boring or whatever the case may be, like, I'm super sorry, but this is just really, really important because it can cost you a lot of money long term. Okay. Care about you guys, and I want you guys to not like screw yourselves over 10 years down the road when you have like a bunch of loans and a bunch of properties. And then the last thing I would say in regards to picking the right loan is going to be the docs for the closing cost. Just read over it. You know how many times I had a loan one time where we sent in earnest money of like $5,000 and they forgot to add it back into the loan. So I was literally going to pay my that $5,000 again, and all it was Diego re-looked at the loan. I was like, hey, the earnest money's not on here. Okay, because you want to move quickly when you get a loan. You're like, oh, I just want to get across the table. I just want to sign. And it's like, no, dude, please look at your docs. Everyone's human. So look at your docs, because oh, sorry, I forgot the $5,000 that you already paid in earnest money. It's that simple to lose 5 G's. Even as a realtor, I've had the title company not reimburse me for the repairs I helped the seller with. Always read the docs. 100%. Okay. So the next thing is closing on the right loan. Once you get all this information, how do you close? And we're going to talk about the different types of loans in a minute. But based on this conversation, you're going to pick the right loan based on the information that we just talked about at the top, right? All this information is going to give you a way to like put the banks against each other and pick the right loan docs. Now, here's where it gets fun again. I'm going to get back to getting fun. The bank is going to ask you a million questions in one. Every one question they ask you is going to revert into 2. I'll give you a perfect example. I'll never forget, and this is when I learned this strategy. I was at, I think I was at Lowe's, and I had my banker call me. Say, hey, I got your loan. Great. I love it. We're going to approve your HELOC. It looks like you're doing really, really well. Appreciate you applying. How's your day going? And I was like, oh, it's great. I'm at Lowe's. I'm picking up some material. I'm doing this. I'm in the middle of rehabbing this property. And, thank you so much for calling. And she's like, oh, well, what are you rehabbing? I was like, a rental property. She almost denied my loan because on the application, I hadn't put that I was in the middle of rehabbing another property. Does that make sense? Like, they're just fishing for information. They were figuring out, she was trying to figure out whether or not I was the right fit for this loan. She didn't care how my day was going. And I was like, dang it, like, why did I say that? Like, I didn't think about that. So I literally wrote down, only give information when talking to banks that's requested. Don't overcomplicate your answer. Hey, Felipe, how old are you? I am 31. She didn't ask me when I was born. She didn't ask me my years, none of that. I'm 31, right? So only give direct answers to direct questions when the bank asks. Don't think like, yes, we always talk about building relationships with your banker, but my banker only knows what he needs to know about my life. And that's very important. Loan officers see you as a number. They don't want any defaults. They don't want anyone like, oh, I approved that person, they defaulted on the loan. They want a 100% success rate. Does that make sense? So they're like, oh, should I accept this guy? Should I not? Well, person A and person B look pretty much the same, but it looks like person A, has a little bit better credit score. I'm going to give the money to that person and not person B. I don't know, whatever. So for me, it's not about giving over information or more than they ask for. It's about giving them exactly what they ask for. Don't talk to your banker about the vacations you're taking. Don't talk to them about the car you just bought. None of that. Keep it short. Be specific, but not over. Again, that goes back to my answer of like, how old are you? I'm 31. Oh, when were you born? In May. Where were you born? Nashville. Right? Don't go into some long story. They don't care. I promise you, your loan officer is not your friend. It's a relationship. It's a business transaction. Treat it as one. Be a very good business partner. Be a very good friend, or I'm sorry, acquaintance, but they're not your friends. I know that I've gotten loans denied by giving over information. Okay, so choosing the right exit strategy goes hand in hand with choosing the right loan. So all you guys know that there's 15-year mortgages, 30-year mortgages, hard money loans, private money loans. It's like there's this array of loans. Got some echo there. And it's like, how do I pick the right one for what? Well, the reason there's a lot of loans is because there's a lot of real estate strategies, right? So let's talk about it. A 15-year mortgage is going to be this is, I think personally, the worst type of loan. I never understood why it's there. It's probably made specifically for Dave Ramsey. So a 15-year mortgage, I think personally, is the worst type of mortgage because you have this high monthly payment that you got to pay every single month, high interest, high loan. It's terrible. And regardless of if you have a job or not, the economy, it doesn't matter if you got renters, none of that matters. You're going to be paying a high mortgage. You can't treat it as anything but that. Or you have your 30-year mortgage that can always be treated like a 15-year mortgage if you want to pay off debt fast. But if you have a slow month, no tenants, then you just pay the 30-year mortgage payment, which is lower than a 15, and then you keep your cash flow. So when it comes to just long-term strategies, the 15 and 30-year mortgage, always pick the 30. And if you just are, your heart's set on paying off the mortgage early, then treat it as a 15-year mortgage by paying extra towards the interest. Just don't, and then if you have a slow month, you can treat it back to a regular 30-year mortgage. All right, the next thing. So from there, the balloon loans. So with my bank, so like I had like 5 years to pay off the loan, but I got a really high interest loan to get a property quick. I usually use these when I find great opportunities and I don't want to have to go through the hassle of like all the documents and all the paperwork and just all the crap. I just go to a bank, a bunch of local banks and say, hey, can I get a 5-year loan the interest rate is, I understand it's going to be high. Like I understand this is going to be quick and dirty, but my goal is to refinance out of it in the next 3 to 5 years. And most of the times, if you're upfront with banks about stuff like that, if the banks keep any loans in house, you can get quick and dirty money for long-term real estate, like I did have with one, and then just refinance later where I had the time and I didn't want to lose the deal. Equity goes up in a property in 3 to 5 years, so you don't have to worry about the refinance. I put 20% down. The property went up about 10% in value, plus 3 years of loan pay down, which isn't much, but I was still able to cash out about 30% of the property, get out of a bad loan, got a better rate, got a better mortgage payment, up to my cash flow. So it was a quick and dirty 5 years. A lot of banks, local small banks, will do it if they know the area. I wouldn't go to like SunTrust and request that. I would go to like my local, First Bank, Tennessee or something. So just so you guys know that those options are out there. There's also private and hard money. These types of loans are typically used for like flips, right? For flip properties, or if you're trying to take a deal down and then resell it in 30 days or whatever the case may be. These are very expensive, and I don't want to go too much into these because I think a lot of people already know what private money and hard money is, unless someone has a question about them. The last thing that I'm going to talk about in regards to these type of strategies is transactional funding. If any of you have a bunch of money sitting around in a line of credit, cash, equity, you guys, like Felipe always talks about HELOCs. Another reason I have a HELOC is because I can do a lot of transactional funding. For example, Let's say that there's a wholesaler out there that needs that's got a property in a contract for 100K and is going to sell it for 200K, but doesn't want the buyer to see that he's only got it under contract for 100K. So he's going to buy it cash, and in the next 1 to 5 days, he's going to sell it to the other person for 200K. I'm going to give him the money to buy it cash. And then he's going to give me $2,000 or $3,000 on top of that back when he gives me back my money when the other person buys the property. It's called transactional funding, and anyone with any amount of money from typically $50,000 and more, you can do this. So I do this with my line of credit quite a bit, and I make tons of money on it. If anyone has questions about transactional funding, you're more than welcome to ask, but it's pretty cut and dry.